In this video, we are going to talk about how people use whole life insurance policies to buy and sell real estate. So when it comes to whole life insurance policies that are specifically set up for maximum cash value, real estate investors have used them for a very long time, long before I've been in the industry. And the reason why, there's several reasons why, but if I were to narrow it down just to one thing, just through experience of working with individuals and why real estate investors are attracted to cash value life insurance products, why they use them, is because they resonate with the fact that they can leverage the policy in a similar manner to how they can leverage real estate. So, for example, if you're a real estate investor, have you ever acquired a piece of property by leveraging an existing piece of property that you have? Maybe you refinanced a piece of property, maybe you took a line of credit out against it and you borrowed against some of the equity on an existing piece of property that you've had to purchase another piece of property. A lot of people do that. Some people don't, but a lot of people do. Now, with a cash value life insurance policy, you can do exactly that. So let's go through an exercise here real quick. Let's pretend that you have a piece of property and we're going to assume we're in a perfect world. Everything is going to go your way. That property is guaranteed to appreciate somewhere between 3 to 5% every single year, regardless of what happens in the real estate market, the economy. If there's another 2008 or major real estate crash, your property will continue to appreciate. Let's just pick the number in the middle, say by 4% every single year like clockwork. If you ever want to take a loan against your property, you're guaranteed access. In fact, there's no underwriting and you've got a fixed loan interest rate of 5% in this example. You typically get the funds anywhere between 1 to 5 business days and you can repay that loan at leisure. You can even elect not to pay it back at all. Although if you're using it to acquire more property, it makes sense to pay it back. Based on those parameters that I just mentioned, would you be interested in a bank that would offer this? A lot of people would, of course. Now, why I mention all of that is how a whole life insurance policy, specifically the cash value benefit, works. When I look at the cash value of a life insurance policy, if it's set up properly, and if I'm using one of the top companies or 4 major mutual companies, it is a safe, liquid, tax-free area to position money. Those core benefits exist with any life insurance company. It doesn't have to be the top 4, but this guy, that 3 to 5% net growth rate, net internal rate of return, not the dividend rate, but what I will see the policy actually grow by if I do everything right, will fall somewhere in that neighborhood, between 3 to 5%. So the benefit there, and why a lot of real estate investors are attracted to this, is they view it as, here's a place that I can position capital. I'm guaranteed growth. It's safe, regardless of what happens in the stock market, real estate market, whatever. I'll continue to see this appreciation, call it 4%. It's tax-free. I really like that. I'll add here tax-free if we do things properly. We don't want to trigger a MEC or cash the policy out with a gain. There's occasions where I can run into a taxable event, but it's easy to do things right. So safe, tax-free, but then liquid. I can access that cash value. And the fun part here is just like accessing equity against an appreciating piece of real estate, what happens if you've got a piece of property, say it's worth $500,000, and you borrow $400,000 against it? So you took $400,000, you've got access to equity, you take that out, the fair market value of that $500,000 piece of property that you own. Does the 4% depreciation continue to occur on the full $500,000 value, or only the $100,000 that is remaining in equity because you borrowed $400K? It's on the full $500,000. That's the fun part. Now, if I can guarantee that it does nothing but appreciate, it's like, okay, sign me up for that. So where we see that interest initially generated by real estate investors is this. They say, okay, I can use this as a safe place to store capital and then acquire more property, and I can use it however I want as the years pass. It can be for real estate. It can be for your business. For example, we've got real estate that we own that I have used not to acquire other real estate, but for my business. The reasons why is, one, it made more sense just from a business move, just from an overall return standpoint. But then second, I had more fun with it, right? Putting money in the business, call it active income. I have a lot of fun with that. Nothing against real estate investing. That's just what I decided to do. So how it's used here is often as an alternative to a bank. When it comes to working with a bank, a lot of real estate investors we work with do that. Most do, especially in the beginning. Even seasoned real estate investors will continuously work with banks because it's the power of leverage. They're used to it. They're comfortable with debt. They're experienced. They know what they're doing. But a lot of people don't like working with banks. So how can I use a cash value life insurance policy as an alternative to working with a bank? So let's take a look here. This is an illustration, or I should say a page from an illustration from one of the largest life insurance companies in the world, good old New York Life. So when we look at this guy, this illustration is going over a concept. They refer to it as bank on whole life. There's a million concepts with different names out there. You'll see infinite banking, bank on yourself, cash flow banking, all revolving around the idea of using a whole life insurance policy as a bank or banking on it. So when we see it here via an illustration from a life insurance company, what do we see? You can borrow money from the bank, or you can borrow money from yourself. When they say yourself, they were referring to your life insurance policy, the cash value benefit specifically, not the death benefit. Question that sometimes comes up is if I just start a life insurance policy, I make the minimum payment only, and I have a $1 million death benefit, can I borrow against that $1 million death benefit? No. The cash value is the gauge that determines how much I can actually access when it comes to taking loans against the policy. I almost said property. So I like this piece here because it just gives a couple quick bullet points, the difference between a conventional bank loan and a policy loan. What do we see here? Approval process. With a policy loan, no approval process. Specifically, we just request a policy loan, we receive it, that's it. Typically in 3 to 5 business days, if direct from the life insurance company. Possible denial with a bank, direct policy loan cannot be turned down. Over here, bank loan amount limited by bank determination. Here, loan amount limited to the policy's available loan value. And that will be whatever your remaining cash value is every single time, or between 90 and 95% of whatever your cash value is. With a bank loan, need credit. The loan can also affect credit. Over here, no credit check, won't show up on a credit report. It is classified as a policy loan. When we hear the word loan, what do we think? We think payments and interest. With a life insurance policy, we're not required to pay it back. I like the verbiage here that New York Life uses. They've got no fixed payment plan. Why I like that verbiage is when you look at life insurance policies, you're not required to pay loans. However, if I'm actively using the policy, it often makes sense to repay the loan. And what we like to look at, you're going to see examples in this video and the next, are examples of what a policy looks like if I take a loan against it, pay it back, everything looks beautiful. But what if life happens and I can't pay anything back, or I can only partially repay it? Say it's interest only. Seeing that up front is so beneficial for anyone who's considering a policy before they dedicate resources, dedicate money toward it, because this gives them really a picture of what things look like if things do go south. Hey, if I don't pay it back because I was told I don't have to, if I don't pay it back, what's the impact on my policy? A danger is if a policy lapses with a large loan on it, I could be facing a large taxable event. It's dependent on how much I've paid in. Has the cash value grown above my cost basis? Do I have a gain on it? We've got other content on that. But we've got some nice bullet points here as far as the differences or the difference with the different loans direct from a policy or from a bank. And we've got it on literature from one of the largest life insurance carriers in the world. Good old New York Life. I like the Frank Sinatra song. All right, so how it's used by real estate investors here. We see alternate to a bank. That's a nice feature once I build up enough capital where I can access the cash value for other opportunities. It's a source of financing. Some view it as a personal line of credit, easy to access. The entire cash value continues to compound. So what that means is if I've got money in cash value, I take a loan against it, any money that is still remaining in equity, and what I've borrowed against the property continues to compound. No lost opportunity cost is what people like. Time is money. Banks are slow. This does come up. If you've already got a line of credit established and a good relationship with your bank, that might not be as much of an issue, but this is what some people do raise. So then I don't need to wait on a bank. That's the same thing right there. Some awareness here that I want to provide. So with a policy, I do need to fund it before I can heavily use it to acquire a piece of property. Let's say that I want to acquire a piece of property in 6 months. And the down payment I need, or I want to buy it outright, say it's $500,000. Can I start a policy today, say with $10,000, and have the ability to acquire that $500,000 piece of property through my life insurance policy? There's no way. I've got to have the capital of the $500,000. So how this would work is I need to fund the policy first, which if I have a very large lump sum, yes, I can infuse it into the policy, then leverage the policy, meaning I can take a loan against it to acquire that property. That'll cause me some initial pain. It'll hurt me more than it will help me, especially in the early years. Yes, I recapture that over time, but that doesn't always make sense. I'm long-winded here. My point is we need to fund the policy up front, meaning we need to build that capital, our cash value first, and then whatever I have in cash value, I can then access it. A lot of people have expressed it like this. It's almost like a bank account that's earning 5% or 3 to 5%. That the internal rate of return will range depending on your age, health, how much you're funding the policy with, a couple factors there. And then the last point, cost to borrow versus net growth rate. This is so important to hit on because it has caused a lot of buyer's remorse for a lot of people. Have you ever heard the saying, you can put money into a whole life insurance policy, you have a dividend rate of 6%, and you can take a loan against the policy at 5%. A lot of people have heard that. When I say that, you can put money into this whole life insurance policy, the dividend rate is presently 6%, and the loan rate is 5%. What goes through your mind when you hear that? What went through my mind was, that's a positive 1% spread. Why on earth would I not do that? Well, what if you did that and then found out after the fact that the dividend rate is 6%, but your money is not actually growing by 6%? So with a whole life insurance policy, or any life insurance policy for that matter, whatever the dividend rate is, call it the crediting rate, I will never see my money actually grow by that dollar amount. I hate how it works just with the terminology in the industry, but it kind of is what it is. So what I mean when I say that is if I have a dividend rate, this is very important here, say of 6%, my net internal rate of return, we can refer to this as the net growth rate. In the early years will be negative. We're going to look at an example so you can actually see this. But as time passes, that'll top out, let's call it right around 4.5%. Based on the projection, and the projection will change. This is why I always say that 3 to 5% net growth rate, because that's what we have actually seen in reality, meaning real policies that have lived the test of time, not just projections. But the reason why I'm not earning that full 6% here is because anytime we see a dividend interest rate that is a gross rate that is credited after the company's insurance expenses, mortality charges, everything that comes with the actual life insurance policy. So let's continue on here. Loans, how policy loans are viewed. We kind of hit on this with the loan sheet from New York Life is the cash value. That is your equity. Whatever you have in cash value, that determines how much you can loan against the policy. The death benefit will be collateralized dollar for dollar every time you take a policy loan. So if you have $100,000 in cash value, $1 million in life insurance, you take a $50,000 loan against the policy, the death benefit pre-loan was $1 million, post-loan, it's $950,000. If you repay the loan, you see your cash value restored to what it would have been as if you never took one in the first place, and your death benefit is restored as well. If the policy is non-direct and direct recognition, you will see a little bit of a difference, particularly with direct recognition, but it's typically marginal. It doesn't make a huge difference if I'm with one of the major mutual companies. Loan interest paid to the insurance company. Loan interest is not paid back to myself. So anytime I have a cost to borrow, goes to the insurance company. Quick example here with some visuals. Let's assume you've got $100,000 in cash value. That's appreciating at 4%. That's 4% net, your actual internal rate of return here, not gross. So that's my 4% IRR. You elect to take a loan for $50,000 to go buy a piece of property. Say it's a down payment. In the beginning, if you're funding that policy, you might partially finance a piece of property through your policy, and then the other partial finance will be through a bank. A lot of people start with a combination of both until their policy gets big enough to take over, or some just build up their policy values, use it as a backup, and continue to leverage a bank for a more attractive cost to borrow. So in this example, we'll assume 5% cost to borrow. That goes to the insurance company. You've got $50,000 remaining in equity that you can access again if you want to. That 4%, even though you've loaned $50,000, is still applied to the full $100,000 in this example. No lost opportunity cost. It continues to compound as the years pass, and that is the fun part. One of the many fun parts when it comes to whole life insurance policies. All right, so we're going to take a look at some examples in the next couple of videos. We're going to look at different loan rates, different companies, different products. We'll hit on an example of a cash value collateral loan as well. Before I jump into that, what I want to touch on here are the main points of concern. Why people don't do this. Very important to be aware of this. It's kind of like that situation where you're talking to a salesperson. They're going through all the benefits of the product or the service you're looking at, and you can't think of any drawbacks. But drawbacks exist. Like drawbacks exist with everything. Like, what's the drawback? And then you work with that salesperson who says, hey, just for your awareness, here's some of the drawbacks people have seen or what they have expressed. So from an awareness standpoint, when people have been made aware of this up front, they've been very, very happy. Oh, okay, I'm glad I knew that. I'm still going to proceed forward, but I'm glad I know that. This way I can prepare for it. Or, thanks for telling me that. This is not a fit at all, or it's not a fit right now, but it's good that we know that stuff up front. So here's the drawbacks here. Two main drawbacks. There's more, obviously. What we've got, main points of concern, liquidity, particularly right up front in the early years. And we talk about this a lot in our policy design videos. When we design a policy for maximum cash value, no matter how well it is designed, what's the worst part about that policy? You pay $1 in year one. Do you have that full $1 in cash value? Do you have more than that $1 in cash value, or do you have less than that $1 in cash value? You've got less. And the reason why is because the premium piece, when we actually design the policy, is not showing up in cash value. No compounding has occurred. The worst year of a whole life insurance policy is the first year. Now we can do things right. And if I pay in, let's say it's not $1, say it's $10,000, and that policy is set up correctly, I should see in cash value anywhere between $8,000 and $9,000 right off the bat, which is what I want to see there in the first year, and then each year it gets better and better thereafter. But liquidity, or let's call it lack of liquidity in the early years, the first year more than anything else, that is a drawback. It's been expressed by many as a drawback because as a real estate investor or business owner, you could look at that and say, hey, the loss of liquidity here, it's $1,500 if I take the figure in the middle. I could use that for something else, for more real estate. Add 2 zeros to this scenario. Now it's a big difference, right? I've got a $150,000 loss there. So that's what people look at. That is one of the concerns. As long as I'm aware of it, and I say, okay, I like the long-term benefits here. Reduce the short-term pain as much as possible, which is what we do when we set up policies. This way I can use it sooner than later. But even when it's optimized for the consumer's benefit, I still have that loss of liquidity up front. It's reduced, but it's still a loss. And then the growth rate versus loan rate. This is very important just to highlight. You can't do anything really about the growth rate. I mean, we can design a policy properly. If it's designed for maximum cash value, that will improve the internal rate of return, guaranteed and non-guaranteed. But say I top out at 5%. If the design's maximized and I'm earning 5%, I can't do anything to that policy to enhance the performance and make it produce 6%. It's dependent on the insurance company that I'm positioned with, where they're allocating their money. Like, it is what it is. So that growth rate, when I look at it, what is the policy growing by compared to what is the cost to borrow? That's the question. And that's what people want to be made aware of. So we're going to look at that in the next several videos. We will have quite a bit of fun as we look at that. Just to kind of set the stage as far as what we will go through is as follows. So let's take a look here. One of our many Excel comparison sheets. This is what we're going to take a look at. So this is one sample here with MassMutual. We will look at the detailed illustrations as well, so you can actually see where your money's going if this is you. But let me just touch on this and we'll wrap up with this. Here's a policy that's set up for maximum cash value. You can tell 100K in, almost 90% in the first year. In yellow represents your break-even point. 4% cost to borrow. In our next video, we'll tally up the total interest payments and everything. But here's what we do. $500,000 loan. Look at your cash value here and also your death benefit. Compare it to this. In year 6, see how the cash value drops when I take that $500,000 loan? The cash value is my equity that determines how much I can take a loan. The death benefit is collateralized. How much did I borrow? $500,000. What's the death benefit drop by? Just about $500,000. Now, in this example, we paid it back, first interest only, then we paid it back. And we'll go through this in detail in the next video, but here's all I want to hit on. What do you notice about year 15 when it's paid back? In the example where you parked money and just let it sit and grow, compared to the example where you took that loan and then repaid it. Everything is 100% restored to exactly what it would have been as if you never touched it in the first place. No lost opportunity cost. The money keeps on compounding. So this is what attracts a lot of people to it. Now, again, as we have some fun, we'll plug in what am I earning here via the net internal rate of return. What's the actual cost to borrow? It's 4%. So when do I actually hit 4% on the internal rate of return? Doesn't make sense for me to borrow in the early years because I'm negative. I take almost a 10% hit. The questions that come up throughout the process, the key points of awareness. This way I see everything. It is what it is at the end of the day, and I can make an educated decision. So I hope you enjoyed this video. I always enjoy talking about this stuff. If you did, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. I do look at those and would love to answer any questions, prepare any case studies. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.